Hello everyone. In this video we're going to discuss candlestick charts. Now, candlestick charts originated in Japan back in the 1700s. Now, the great thing about candlesticks is they show a motion by visually representing the size of price moves with different colors. Traders can use these candlesticks to make trading decisions based on regularly occurring patterns that help forecast the short-term direction of price. So candlesticks use 4 price points: the open, the close, the high, and the low. So let's take a look and let's break down some basics with candlesticks. So as you can see, we're looking at a daily chart. So that means each candle represents one day. Now we could change that to 1 hour. We could change that to 4 hour. We could change that to weekly. So basically, with this on weekly, all that means is each candlestick represents what happened in 1 week. The current week that we just had, last week, and so on. So let's take a look at this. Let's go back though to the 1 day, which is what I look at as a first thing. I'm always want to see what price did in the day. So whether it's a stock, a cryptocurrency, a commodity, whatever the case may be, you can use candlesticks to determine where price is going next. So we're looking at Apple stock on the daily. Here's March 5th. So what we can make out here is you can see that some candles have large bodies of the color, the green and the red. And some have smaller bodies like we see on March 5th. You can see just a tiny bit of green area, and then we have these long lower wicks and a bit of an upper wick. So these are wicks, or lower shadows, upper shadows. I personally call them wicks. And then we have the body of the candle. Now, a green candle is clearly it means price is going up. Red candle is going to mean we're going lower. And it's simply, when we're looking at a green candle, we have the open price, we have the low, which is the lower end of the wick, and then we have the high. You can see there's just a tiny wick. There's just a tiny wick on this one, and then we have the close price. Whereas the red candle, we're opening up at the top. We have this little high here with the upper wick. And then we have the low down here, the lower wick, and then we have the close. And that is what makes a red candle red and a green candle green, in that close is going to be lower than the open, right? Because we open here, we close here. Whereas a green candle, we open here, we close here. That's what makes it green, and that's what makes it red. So we can see, like I pointed out in the beginning, a lot have long lower wicks, and you're going to find some that have longer upper wicks. You can see here we got a long upper wick. You can see here we got a long upper wick, and sometimes there'll be no wicks at all. And let's see if we can find an example where there's absolutely no, or very small. You know, this one, there's a tiny lower wick, not a lot of upper. Well, we'll just see if we can find any where there's pretty much zero. It's pretty rare, but it does happen. Anyways, let's keep rolling. So The idea with candlesticks is because trading is often dictated by emotion, the candlesticks can tell you what's going on in the trader's mind. So when you see a candle opens up here and the sellers drive it down, showing this lower wick, and then the buyers buy it back up, driving it to a higher price, the momentum is all to the upside from here. So that's a very bullish candle, right? Because we're closing the day or the candle with the momentum being mostly bullish, because in the beginning the sellers were in control driving it down, and then the bulls took over and closed it back up. Momentum is clearly bullish. Whereas if you get a situation like this candle, or even this little candle, but let's take a look at the big one. You can see price opens up here. The buyers drive it up to this upper wick, and then the sellers come in and sell it off, closing it lower. The sellers are in control, and that's going to lead to the next candle, more than likely, more downside, which you can see happens here. In this situation, it's a smaller candle, but we're opening, buyers are driving it up, and sellers take over, driving it down, and then you can see we go on a pretty significant drop after that. Here's an opposite scenario where we're opening, sellers are driving it down slightly, and then the buyers are taking over, closing it to the highs, and then that leads to upside. We're going up after that. So those are very, very bullish style and bearish style candles that I look for on a consistent basis when I'm looking for entries. Now, the next thing we need to note is you're often going to find large candle ranges and small. So for example, you can see here we have a high on this candle, and we have the low right there. So that's a big range when you compare it to, say, this little candle, or this one's even smaller. Small little range here, small little range there. So these are both daily candles. So in this day, we just had this small little range. In this day, big range. So those are some differences. And for my trading style, I stay away when we have these big range candles, because that's just showing it's very volatile. And what I like to look for are entries on small candlesticks. So it's important to find the smaller range candlesticks and look for entries on those. And let's take a look at some examples on that. Okay, so we can see big ranges here, more big ranges. This is a pretty big range as well. So on Apple stock, you can see we're going up nicely, nice uptrend. What I'm looking for is a smaller range candle on the breakout. So you can see here, here's a small little candle here. I'd look to enter on the next one, next bar. Here's a small rangy candle. I'd enter here on the next bar. Here's another one. I'd enter here on the next bar, and another one. Now, if I show you an example of a big rangy candle where I wouldn't get in, right here. So we're going up, but we get this huge big rangy candle. I'm not going to get in on this candle here. Not only does it gap down, it's too big of a range. So I'm going to stay out. Now the next thing you'll notice with candlesticks is sometimes there's gap ups and gap downs. So you can see in this instance, we closed here, and then the next candle, we opened way down here. Price came up, came back down, right? We opened, we closed, and then we opened. That's called a gap down. Here you can see we closed here on this candle, and then we opened up here. That's a gap up. So I like to look for entries where we don't gap up at all or very little. Because when you gap up too much, the likelihood that we're going to drop or go the other way are very, very high. So here you can see we gap up and then we end up dropping, because sometimes we have to fill that gap. Let's look for more examples of that. So here we're closing, and then the next day we gap down. We have this big gap down, and then we go up after that. Here's another example. We close here. The next candle, we gap up. We go up a little bit more, but then we end up dropping after that. So it's important when you look at candlesticks, you can see how tight these open and closes are. They're not gapping up. They're opening and closing very close to the previous day's close. So you look at this, price is closing at 50.78 on this candle, 50.78. The next day it's opening at exactly 50.78. So it doesn't have to be exact, but I'd rather be looking for an entry in a situation like that. Another example would be, here's a breakout, and on this candle we close at 44.73. The next day we have a slight gap up and we open at 45. It's not that bad of a gap up, so I would still look to enter. But when the gap ups become too big, it's best to stay out. Like, look at this big gap down. Now sometimes these gap downs or gap ups can happen when there's earnings or volatility pre-market or post-market, when the market hasn't opened yet or when the market hasn't closed. Maybe there's negative earnings that came out after market or before market open, and then that could send a stock opening lower than the previous day's close. So you can see on this candle we closed at 39.48. The next day we open at 35.99, but then we got a rebound to fill in that gap. So you get these gap fills where price needs to fill that gap in. Candlesticks are very, very powerful, and my favorite candlesticks are the bullish and the bearish candlesticks, like I discussed in the beginning, where you have a bearish one would be a long upper wick red candle, or a green candlestick would be a long lower wick. And typically when you're looking for a bullish move, you're going to be looking for that long lower wick on a green candle. Or if you think a stock is going to drop, you're looking for a long upper wick on a red candle, just like this. There's that bullish candle here, lower wick, solid body. We break out to the upside. Even a red candle with a long lower wick is often going to mean we're going to go higher in the coming candles. Whereas a red candle with a long upper wick means we're going to go down. So that is going to sum up this video on candlesticks. Candlesticks are very, very powerful. There's lots of different candlestick patterns to learn. I think it's very important to just focus on the ones that work the best. And by these ones are what I described. Just look for long upper wicks and long lower wicks. And they could be either color. So a long lower wick is going to mean a good percentage of the time, not all the time, we're going to go up after, right? A lot of upper wicks mean we're going to go lower. So that is how candlesticks work and how I use candlesticks.